And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. It is a sign of the times as risk appetite has grown. Assets under management of leveraged and inverse ETFs has grown dramatically. It was about 2% of ETF assets in 2016. It's almost 8% today. That's real growth. More importantly, trading volumes exploded on any given day. Dollar volume in leveraged and inverse ETFs are often among the largest daily dollar volume ETF leaders. So what is behind this explosion of interest? Who exactly is doing all this trading? Let's talk with Douglas Jonas. He's the CEO of Direction, along with Todd Rosenbluth, head of research over at Verify. Doug, I presume everybody knows you are one of the largest providers of leveraged and inverse ETF products. Every day I look at the volume charts. I see your semiconductor bull ETF. It's always up there in the dollar volume charts. It gets 3 times the return of the semiconductor index. Those of you who don't know that on a daily basis. Your 3X S&P 500 always shows up on the volumes. Just tell us who's doing all of this trading. The volume really has notably moved up in a while. Who's doing it? Give us a sense.
Volume and assets. I mean, the reality is it's no surprise to me that you're seeing the Direction lineup of ETFs on the chart in the top 10, top 20 ETFs traded every day. Those out there, you know, we think is when we try and measure this, we think about 3/4 of the folks trading are retail, and another quarter is institutional. And you know, it's interesting when those are there's varying use cases for why you would want these leveraged ETFs. They tend to be all short-term in nature, which is, I believe there are some news coming out that I want to trade around. We've got NVIDIA results coming out Wednesday, right? There'll be a lot of movement and traffic there. Could also be reactionary to what we're seeing in terms of headlines. Could also be, as simple as a trade desk or an individual saying, I want to hedge my position. You know, we have a lot of securities in the market that are up a lot over the last 5 or 10 years. Market seemingly has been going sideways. We saw Friday's correction. There are people out there that are saying, hey, maybe I don't want to be fully invested, but I also don't want to take the capital gain on selling a position. Yeah. What can I do? I can take a long position in a short ETF, an inverse ETF. I can basically neutralize my exposure.
I want to put up that full screen we just put up, who's trading leverage and inverse ETFs, because there's an interesting point you're bringing up here. You say about 12 to 15% of the volume comes from outside the U.S. South Koreans, you mentioned? I've heard this before from the 24-hour-a-day exchange people. South Korean, young South Koreans, young Japanese. Who are these people?
You're right. You know, it's hard to measure again, but you know, thumb in the air, we think somewhere between 10 and 12% of the assets in all of these leveraged and inverse ETFs are coming from outside of the U.S. The use cases are often the same, but a lot of times it's often, you know, investors who want to participate in the U.S. markets. There's a lot of news coming out of the U.S. markets. There's also been a lot of growth out of the U.S. markets. And so if you're an investor outside of the U.S., in particular, a lot of these Asian-based countries, they do have access to the U.S. market through the New York Stock Exchange. They can trade ETFs and securities that are listed here at the New York.
And Todd, one of the things that's amazing is when I talk to people about this, these people overseas, they have kind of flattish markets, and they're watching, you know, on TV. They're 12 hours away, and yet they seem to want to try to participate. This is sort of part of the impetus around the 24-hour trading story. You know, the foreign traders. It's quite remarkable to watch this kind of level of interest. I gather their local markets aren't as interesting, and so they try to figure out. They're very, shall we say, not risk averse necessarily. They seem to be quite eager.
Well, the biggest and strongest companies in many cases are in the United States, whether they're technology companies, Apple and Microsoft, NVIDIA, or they're other growth-oriented companies that you can find single stock leverage ETFs. So we're finding more and more investors, retail, as well as some advisors that are learning about ETFs because through the individual stock, and then they're getting the benefits of diversification and liquidity that they can get through that ETF wrapper.
Now, so when you talk about institutional investors, you said about 25% of people here are institutionals. You're talking about a broad swath, like hedge funds, trading desks, large brokerage firms?
Yes, yes, and yes. I mean, there are a large amount of institutions. There's even, you know, how you categorize registered investment advisors. They might have a sleeve of assets that they have for very aggressive positioning, and they'll use leveraged and inverse ETFs. But going back to large hedge funds, those that are really reacting and want to try and pre-react to a lot of the market news out there, they want to take short-term positions on individual companies, and they also want to do it on the overall market. it could be semiconductors, it could be the banks, it could be home builders. There are a lot of market moving headlines happening every day.
Could be anybody who has a book of positions that wants to be neutral to the market.
That's right. Or even if you think about a trade desk, right? There are folks that are surrounding us here on the exchange floor that have large positions in a lot of securities. They might want to neutralize their risk, or let's say they're short the market, they need to bring that back to zero, and they'll do that using the direction lineup of ETFs.
Todd, the assets in leverage inverse products are becoming a larger part of the whole ETF universe. This is what's interesting to me. I mentioned 2% of assets in 2016, it's 8% today. I know Direction and ProShares, they're sort of neck and neck in terms of the largest ETFs in the space. I look at ProShares Ultra Pro QQQ, there's competition here, TQQQ, they're 3x leverage exposure to the NASDAQ 100, $26 billion. Look at this in assets here. Single stock ETFs that leverage NVIDIA and Tesla are also really big. There's Direction Semiconductor Bull, 3x, almost $9 billion. And like I said, it's not just leverage and inverse index ETFs. The single stocks leveraged ETFs, they're growing fast as well. There you see long NVIDIA, there's long Tesla that are there. These are among the heaviest volume ETFs out there, 2-time long NVIDIA as well. Comment on this. I mean, it's remarkable to me to see the assets growing. Now you can say, well, yes, there's a certain bull market effect here, so the assets under management tend to go up, but even the average daily trading volume has been going up, the dollar volumes have been going up, and the assets under management are going up. So all the metrics, you can't just say, well, the market's overall is going up, therefore no surprise here.
Right, the leverage and inverse industry has evolved. So TQQQ was the first of those ETFs that I can recall, 15 years old. But as you showed on the screen, Direction, ProShares, others now have single stock leverage ETFs that have become very successful. And the single stock leverage ETFs probably sounds hard to wrap your head around, but it's one stock, you get the risk on, or in case of inverse, risk off exposure to that, and the liquidity benefits of the ETF wrapper. So we're seeing more investors turn to that. At our websites, ETF Trends and ETF Database, we get disproportionate of our traffic towards our leverage and inverse channel because people want to learn about individual stocks, learn about the ETF exposure to that. And so the volume and the interest is perhaps even stronger than that asset base.
You know, you can slice and dice this a lot of ways, but what I have noticed every day is of the top 20 ETFs by dollar volume, there's usually 5 or 6 that are in the top 20 right now. So the ProShares Ultra Pro Triple Q, your daily semiconductor bull always shows up in the top 20. Your Tesla bull, TSLL is the symbol there, always shows up in the top 20. ProShares Ultra Pro Short, QQQ, Granite Shares Long NVIDIA, these show up routinely in the top 20 ETFs right now.
I mean, the reality, Bob, is the markets today, they are direction weather, right? It's not the old days where we wait for an earnings report, we see if there's some growth, we wait for the CPI or PPI to come out. There are market moving headlines happening 2 to 3 times a day, and so the volatility is growing up, not down, and we think that holds for the whole year. So if you're a hedge fund, if you're an individual trader, or you're an RIA, you're probably needing to react to that in some way, and so it's no surprise to me that those with short-term investment views are going to play that out in the form of a leverage or an inverse ETF.
Right. Now, I'm going to do 30 seconds of nerdiness, okay? I always do this, explain it.
You've got the right crowd here.
Can you explain how you get the leverage briefly? I mean, we usually say, oh, they use futures and swaps and options, but for example, how does a 3X semiconductor actually get that?
Yeah, I mean, you brought it up, and we'll be nerdy for just a few seconds here.
30
seconds tops, okay. All of our ETFs that are using leverage, we do it through the form of what's called a swap. So you're basically going to an institution, a bank, and you're saying, hey, I want you to give me back the performance of 3X semiconductors for 1 day, and the swap is intricate, there's money movement, there's collateral, there's things to make sure that it's safe and done through clearing, but at the end of the day, basically you're getting the performance as named. Now, you did note, there are some of these ETFs out there that don't get full performance coverage through a swap. They're doing it through options, they're doing it through futures. It could be they don't have the relationships, it could be they just don't have access to the banks. And you're seeing, and we saw the headlines, some of those ETFs not able to reach the beta they want to perform. So for the direction lineup of ETFs, we make sure we're hitting the performance.
Is that an
they're
issue,
supposed to.
not getting the performance?
It is. So he's not going to refer to his competition, but we've seen some
But
strategies.
you can.
Yeah, but he can.
We've seen MicroStrategy is a stock that we have single stock leverage ETFs. And that's not a large stock. So it's not Apple, it's not NVIDIA. And so we did see some of those ETFs that were leveraged tied to that. They couldn't deliver that exposure through a swap. They had to use other means. That offers a different experience for the investor. So it's important to also know who is behind the firm, behind the ETF.
You got to do a lot of homework here. What happened to just buying the S&P 500?
You've been saying it for years, right? You've been saying it for years. It's about education. That's right. This is about education, Bob. I mean, you've said it for years. We'll say it again. You need to learn about how these ETFs work. You need to understand daily leverage. You need to understand the daily reset. We provide a lot of this education on our website, directionetfs.com. Vetify does as well, but you're right. You need an investor that's out there that's not an institution, they're not a hedge fund. They need to go and learn exactly how they work.
But it's become even more complicated. So the broad S&P 500 or NASDAQ 100 or that you should have more confidence in using those leverage and inverse ETFs to know that there's enough liquidity. The liquidity of the underlying stock market or the S&P 500 or the NASDAQ 100 is quite strong. It's when we get into these single stocks that are not mega cap stocks, the risk becomes
Well, you brought
greater.
up the daily reset, so here we go, folks. The annual, let's explain the daily reset here. So retail investors have had a very hard time getting their head around these products because of this daily reset, folks. So what happens, if you don't know, they reset every day. So if you hold them for more than a day, your returns may vary wildly because of what's called compounding effects. So Todd, how would you grade the ETF leverage and inverse industry for educating investors about this critical aspect? Are people better educated than before? Remember, we used to do this 7 or 8 years ago. People could not get their head around the daily reset.
So I think investors are better educated. Those who have been using these products are better educated. Doug's firm, other firms that are established within this space have done a good job of educating, and on their website you can be able to see that information. The challenge I have is that many folks are not visiting the website of an asset manager, or they're not visiting our website where we have education content. They're just going onto their brokerage account or on their phone even and just buying something because it is a single stock leverage ETF and thinking they're going to get 2 times the return of NVIDIA when NVIDIA reports results today. It's a little bit more complicated than that. And so before you buy anything, go to the fund website, see what they'll tell you.
Yeah, I want to give you all, this sounds very difficult to get your head around, but I want to give you a very simple example of how it goes different than your expectations. So let's take an example of you put $100 into the S&P 500 over 2 days. We have a full screen that explains, say it's $100, and say one day it's up 10%, and the next day it's down 10%. So on $100, on the end of the first day, you have $110, right? And then it's down another 10% the second day, and you have $99, okay? So there's a typical example of what would happen if you would think that you're just owning that. Now, if you're 2 times leverage, you think you might be down 2% there, but in fact, it doesn't really work that way because of the compounding effect. So here's the $100. Here's what you have 2 times leverage. At at the end of a day, you have $120. If you're 20, move 10% in the S&P 500. If you're leveraged 2 times, you have 20% return. So now instead of 100, you have $120. That makes sense, right? Now let's just say the next day you're down 10%, and instead of your loss is 20% because it's 2x. So you actually have 120 times 0.8, you have $96 here. You would think that you're supposed to have $98 if you're down, but you actually have $96. This is an example of compounding, and it gets fiendishly more difficult. This is the simplest example I could come up with. It gets fiendishly difficult when you go into several days. So this is a simple way for you to understand it doesn't necessarily work. And when the momentum is going in your direction, you're fine. When it starts getting choppy, then things get really weird if you hold it for
That's why it's so important. I mean, you look at the name of every single one of these ETFs, they say daily in them, and it's so important. I mean, education is key. Every investor that's using these should know exactly how they work, and they should be looking at them every single day, hence daily.
Yeah, so the point here is essentially, Todd, that these ETFs can systematically underperform over time. This is what we're trying to get across, folks. The other issue is as you heard here from Doug, they need to use derivatives to get their leverage. So in some cases you can have things like options decay, futures need to be rolled over. This is why it gets really complicated to sort of explain this to people, have them understand what kind of products they're getting. The one thing that's encouraging to me, we were talking to my friends at Granite Shares, they said 30% of their fund turns over every day. That's a sign that people aren't sitting on this for days and days.
Right.
I think the education may be getting better. There. That's what I'm trying to get.
That's right. I mean, it's hard to see all the data, but everything we see tells us the velocity's there. You in this type of ETF, you would expect a lot of turnover, a lot of velocity of holdings, and that's what we're seeing. But again, education is key. Daily reset, daily checking. Come to directionetfs.com. Learn how they work.
And
give
you
us
have
a
little
call.
you have an explainer on your website.
We do. We have a whole education. We've got a series of resources. We also sponsor a channel on Vetify, so vetify.com, another place for education. But reach out to us. We're friendly people. We'd love to get on the phone and explain how things work.
And your concerns seem to be not so much in the index, but single stock ones. And what your advice again to people concerning single stock ones is?
Just go and look at how the fund has performed on the website in that period of time before you purchase it. And is that experience what you would expect it to be? If it is, and you're comfortable with that level of volatility, then it could be for you for the day.
Is there any situation, I know I'm putting you on the spot here, Todd, but is there any situation where this could be a systemic risk, where all of a sudden it's NVIDIA's earnings and there's massive positions in this thing? Could there be a systemic problem somehow? Remember the volatility ETFs of 2018?
Right. So I'm not concerned about NVIDIA. I'm concerned about those smaller stocks if there becomes increased popularity in getting exposure using single stock leverage ETFs. Then you have disproportionate share connected to one ETF and connected to the leverage behind it. That could be a greater risk. NVIDIA, the amount of money that is owned by ETFs in general, let alone leverage and inverse ETFs of NVIDIA, is still quite small. I'm not concerned about earnings coming up this week.
Yeah, I mean, we've talked almost all bull case here, but it's also important to talk about bear cases. We saw a market sell-off on Friday. A lot of investors are starting to look at the inverse ETFs. They're -1 ETFs in the direction lineup, right? So you're not necessarily dealing with the leverage factor, but it does give you a way to remove exposure without taking some capital gains. And when you look at the Mag 7 stocks, I think 6 of the 7 right now are down this year. There are individuals who are saying, how do I hedge my position? And inverse ETFs can be a way to do it without leverage.
And of course, all of this is really a manifestation of risk-on behavior that we've seen. We've seen more explosion in options, zero data expiration options. This is a sort of a manifestation of the I won't call it a speculative fever. I just did, but that's been out there, right? I mean, it's not just an isolated case here.
This is a risk-on environment for investors in general. ETFs are providing access to that risk-on nature, or in the case of what Doug is talking about, the risk-off nature. So you can certainly short an individual ETF yourself, or you could use an inverse ETF, which is easier to be able to do. And so Douglas's firm Direction offers that as an opportunity.
Yeah. So folks, I know we've been a little nerdy here today, but this is what I call the educational opportunity to explain people. These ETFs are getting more complicated every single year, and our job here at ETF Edge is to help explain that to you. We don't necessarily have strong positions one way or another. I have a few thoughts on this, as you probably know. I've had concerns about this particular brand of ETFs over the years, and yet we see more people interested in them. So what we can hope to do is educate people about the pitfalls, about the advantages and the disadvantages of them. That's, again, what ETF Edge is here to do. Thank you for joining us. That does it for this week's ETF Edge. My thanks to Doug and Todd. We have asked Todd to stick around and provide some additional insight into other recent ETF trends. There's a lot of other things going on here, folks. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.